The big news at Los Cabos, Mexico at the G20 summit today is that the Financial Times of London and the Reuters news agency are reporting that the European members of the G20, and specifically the Euro area members, will agree to introduce measures to strengthen the European banking system by agreeing to work towards a true banking union. If this is true, it's very good news indeed, because as we have seen over the last couple of days, there is considerable uncertainty and turbulence in European financial markets, notwithstanding the results of the Greek election. In some sense, what's happening in Europe is the result of moving ahead with a single European currency and creating a highly integrated capital market for the Eurozone without building the institutions that are needed to support that integrated capital market. So if the European leaders here today agree to push for measures to strengthen a European-wide or a Euro area-wide deposit insurance scheme, agree on common measures for the resolution of troubled financial institutions, and proceed with bank recapitalization, it could represent a very welcome step indeed. What's happened in Europe really is that because they've agreed to a common currency, there's no exchange rate risk from moving deposits from one country to another country. And so that if you are worried that your bank in, say, Greece or Spain may suffer from insolvency, you have very little incentive to keep your deposits in that institution. You have all the incentive, all the motive to take your money out of that institution and move it to an institution that is considered to be more stable, i.e. a German bank. So what's happened over the last several weeks is you've seen a steady leak of deposits from Greek and Spanish and other banks moving into Germany, and this has increased liquidity in the German banking system and driven interest rates in Germany down, but it has obviously created severe problems in the so-called periphery countries. And again, this is in some sense a direct result of moving ahead with currency union without all of those other institutions that support it. Because if you had separate currencies and you started to see this movement, this draining of deposits from one banking system to another, you would see the exchange rate depreciate, you'd see that currency depreciate, and that itself would tend to reduce that drain of deposits. At the same time, the country experiencing that inflow of deposits would see their currency appreciate, and that would reduce again the incentive to make those deposit withdrawals and move that money to, in this case, Germany. So we are now, I think, in a situation in which Euro area leaders recognize the severity, the magnitude of the challenges they have, and I think they recognize that they have to move forward expeditiously to address these big institutional gaps.